Today on the CEO Barbecue, we're looking for copper, molybdenum, a little bit of precious metals as well in BC, together with Surge Copper. If you want a bullet point summary of this conversation and all the other CEO barbecues in your inbox once a week, go to researchtalks.com and subscribe to our free newsletter. Now, the company you're about to hear from has paid us for the production of this video, which means that this is not research, it's an advertisement, and you should treat it as such. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. And please only watch this if you absolutely know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, and my business sells content-producing services, which also makes me biased in multiple ways. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital might be at risk. If you're not 100% sure you understand 100% of the disclaimers I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Surge is a development company that owns a large land package in British Columbia where a couple of porphyry deposits have been discovered. They have a 2023 PEA on one of those deposits with a $2.1 billion NPV8 and a 20% IRR on it with a $2 billion pre-capex, pre-production capex, good for 30 years of mine life and an average annual after-tax free cash flow of nearly $350 million for the LOM, all of which calculated at $4 copper, $15 molybdenum, $23 silver, and $1,800 gold, and all of which, of course, are much lower prices than the spot prices of the metals today, which is something hopefully Leif and I can talk about later on. We don't really need the usual in-depth company overview here, neither a smell test, because Leif and I spoke about 4 months ago in what ended up being a 2.5-hour interview covering everything from insider incentives, risks and challenges, growth opportunities, and so on. So if you're new to the story, you cannot afford not to watch that interview first. So I'm going to link it in the description of this video. Surge is listed as Surge, so SURG on the TSX-V, and with just over 345 million shares outstanding and an $80 million market cap. Today, this is a 22-cent stock with a 52-week high of 31 cents and a 52-week low of 9 cents. The 50-day moving average is at 20.5 cents, and the 200-day moving average is at 14.5, which means the stock is trading well above both of those, indicating positive momentum. 3-month average daily volume is about 430, although the 10-day volume seems to be increasing with an average of almost 500,000 shares. Again, no long intro needed here, so I'll just shut up already and Leif, I'll let you do the talking. But first of all, thank you so much for being here today.
Thank you very much, Antonio. I'm happy to be here. And yeah, the interview we did earlier this summer I got a lot of great feedback from it. So yeah, very happy to have another opportunity to be a guest on your podcast. I'm a big fan.
Of course, appreciate it, and I'm looking forward to it as well. I got pretty good feedback on it because I think that's one of the longest interviews that I've done, and it was 2.5 hours, and I'm just happy that people still, care about our sector enough that they're gonna, and a lot of them too, that they would actually go and watch it. So, yeah, pleasure is mine. I see that you've had a couple of news releases since we last spoke this summer, again about 4 months ago. So, maybe just a brief summary. What have you done for shareholders lately?
Yeah, sure. I don't have the chronology of releases in front of me, so apologies if I'm overlapping or repeating anything I've talked about before. But yeah, the big news for us in the summer was the delivery of a MET program. Again, I don't recall if I went into any degree of detail on that last time, but yeah, it was about a year-long program that we were running as part of the kind of underlying technical work that is going to feed into the pre-feasibility study for the Berg project. And yeah, the results were very good. We were very happy with it. Robust kind of program, lots of different, pretty large volume of material, large volume of individual tests across the kind of full spectrum of, stages of the flow sheets and, the different products that are going to come out of this thing, which is a copper con containing precious metals and a moly con. So, when we came out of the PEA, there was some recommendations around this particular piece, and it's obviously been a focus of ours as long as we've owned the Berg project. So there was a lot of preparation that went into it, and I think we were aiming to achieve the types of results that we did. So yeah, absolutely fair to say that we're pretty happy with the results, and yeah, it'll point to both an increase in prospective assumed recoveries for these key metals in the PFS. So the corpus of data will allow us and our independent engineering consultants to derive recovery formula that will point to kind of life of mine recoveries that are likely going to be materially higher than what we saw in the PEA. So that's obviously good, but it's also just a risk reduction. This is a kind of key component to these types of projects. And I think in the PEA, it was certainly an area that we were conservative around for that reason, that there just wasn't the type of work done on it that we wanted. So I think we've really advanced that perspective on the project. So that's probably the main item. And then we had significant financing this summer as well. The color there, it was launched at the beginning of July. It was we've got a significant shareholder in a group called ARM, South African Diversified Mining Group. They, prior to this financing, owned about 15%. We had kind of negotiated with them leading up to this financing to have them increase their ownership to 19.9, which is the kind of maximum thresholds you can do here in Canada. And so it was kind of a couple parts to the financing. One was that private placement bilateral between us and ARM, and the other piece was a public offering to existing and just kind of normal market investors, and roughly half and half. So I think just under 6 million went to just under 6 million went to the public market investors, and about 4.5 to ARM. So it was about $10.4 million in total raised, and the first tranche of that with the public investors closed at the end of July, and then the balance with ARM closed in September. And use of proceeds there, the guidance to investors in the market as a whole was this is going to give us runway to deliver the pre-feasibility at Berg in the first half 2026 and allow the company to complete its EA readiness objectives, its environmental assessment readiness objectives. So what that means is, getting all of the environmental baseline data in place, the document preparation in place, the kind of agreements and soft sort of relationships and engagement all advanced with both the regulatory entities and the government, as well as our First Nation partners, so that when we embark on that formal environmental assessment process, it's we're kind of as set up for success as we can be, in order to kind of keep the timelines moving ahead efficiently and make sure everyone's all the relevant stakeholders who are going to be at the table are kind of party to that. So tons of work is going to go into that. We're sort of soft circling a similar timeline to what I mentioned for the PFS there of the first half of next year, but there's obviously a lot more things kind of external to the company in that case, as opposed to delivering a pre-feasibility, which is just kind of down to us and our engineering partners. So we'll be keeping the market up to date as we are up to speed on those timelines as we progress things over the winter. But we're kind of up to our eyeballs right now in all of the PFS related stuff. And then in the middle of all that, we had a field program as well. So in concert with the announcement of that financing in July, that's the usual time frame that our summer field season kicks off. So roughly from the July timeframe to the end of September, we had lots of activity going on in the field. We had about a 5,000 meter drill program spread across a bunch of different objectives, ranging from resource infill drilling, environmental geochem drilling, geotechnical drilling, various other activities going on around environmental baseline as well. So I think, as I mentioned in one of the press releases, it was certainly a hive of activity. Lots of different professionals at camp for a significant part of the summer. There was no spare beds. It was a very busy place. So, but successful. We had a great field season. Got everything that we needed to get. I think everything's coming out looking the way we want it to. So, company's posture at the moment is very much. Burn rate has come way down with the conclusion of the field season, and over the winter, it's going to be kind of taking stock of all of this technical data that we've gathered over the last 3 field seasons since the PEA to pull it all together into the next big economic study milestone in the form of the pre-feasibility study targeting first half of next year, and advancing all the kind of EA readiness stuff in parallel with that.
The 5,000 meter number there is interesting to me, so we'll definitely be back to that. But and looking at your skin tone, doesn't look like you were able to spend much time at the beach this summer either.
Well, okay, yeah. I mean, I I got a bit of outdoor time for sure. I'm an avid golfer, so try to do a bit of that. But
did you go to site this year?
I mean, I did, yeah. But I'm in contrast to probably a lot of your other companies that you interview, I'm not the geo style of CEO. I got a bit of a technical background, but our president and VP exploration, Shane Ebert, he's the guy that runs the stuff in the field and is very, very hands-on there. So I'm more of an office rat and spend a lot of my time in the cities and doing conversations and marketing and strategic type stuff. But I did make it to 2 sites for about a week toward the end of the field season this year.
Yeah. Again, a couple of things to touch upon there, really. 4 or 5 big points that we're going to be going through here today. Financing first, though, and we'll talk about the proceeds and their proposed destination here in a minute as well. But African Rainbow Minerals Limited, so ARM, is giving me almost $5 million and are increasing their ownership to 19.9%, as you said. You're calling them a strategic partner here, but how or why is it that they are a strategic partner, given that, again, they're an ASX listed and operate mostly in South Africa, right? They produce iron ore, manganese, PGMs, coal, nickel, I think, but not much to do with copper, right? So how are they strategic fit for you?
Yeah, so just to clarify for folks, JSE listed, not ASX. So they're listed on the Johannesburg Stock Exchange.
Oh, that's right. Yeah.
So headquartered in Joburg, and kind of rich tradition there in South Africa. And as you mentioned, most of their operating assets are in South Africa. They've got some sort of downstream refining assets in Malaysia as well. And they do have a history, many years back of some assets outside of South Africa in continental Africa, in places like Namibia, DRC, I think Zambia, etc. So, the current snapshot of the platform, though, is very South African centric, and they are a diversified mining company, as you note, with exposure across a bunch of different commodities. No operating copper exposure today, which I think interestingly is to some degree a expression of the geology of South Africa. I just don't think there's a lot of opportunities to do that in South Africa. There aren't there isn't a huge amount of known deposits or geological environments that are prospective for big copper deposits in that country. Obviously, if you go a little bit north into Botswana and Namibia, and then further into the copper belt, that changes. So they've had copper assets in the past, but divested those, and so the platform, as it currently is configured, doesn't have an operating exposure to copper. But as a diversified mining company, I mean, I would point to examples that probably all market watchers are familiar with in recent years of companies that are not incumbent players in the copper mining business, either executing on transactions or at least kind of rhetorically pointing to that. And that would range from gold mining companies to, you got some, examples that have a lot of institutional overlap with ARM, like Harmony. Harmony is a sort of a related party. They've got ARM has a big shareholding in Harmony. They share some directors and so forth, and Harmony is an erstwhile kind of gold mining company out of SA, but has made some big acquisitions in the copper space in recent years. And yeah, so I think this is I think one demonstration, dare I say, proof of a thesis that I've had for a number of years, which is that the copper thematic, the thesis around copper, the bull market in copper is, I think, a bet, a thesis that a lot of people in our industry share, and it's been building for many years, and I think it's starting to gain real momentum now, but it's been brewing for quite a long time. And I think the basis of it is that a lot of people strategically see there being excellent supply and demand fundamentals in that market, but perhaps of equal importance is it's a big market, right? Like, I think you can look at things like rare earths and graphite and things like that and come to a similar conclusion that there's excellent supply and demand fundamentals. But as everyone, or as people who work in this industry know, a lot of these minor metals are really small markets, and in many cases, when you have market fundamentals developing in a positive way, the way that translates into the corporate development or sort of new mine builds type opportunity set is it's a race to the finish line to get kind of one project built, because the market can't even handle more than one or two mines. So copper is very different, right? Like there's a depth to the market. I think a kind of fact pattern around it that we need. The world needs to produce a lot of this metal in order to achieve a wide range of social development, energy production development, just GDP growth, urbanization, et cetera, et cetera. I've heard this from many people, I'm sure. But in order for the world to achieve a bunch of the stuff, we need to build a lot of new copper mines. And so there's a big depth to that market. And so I think a lot of diversified miners are really keen to get involved in this space, and ARM is no exception. So why do I see them as a strategic partner for us? Well, they're a mining company. I sort of use a very specific definition of the term strategic investor, which is that it's it's like they're not a financial investor. They're not the type of investor that is passive and buying simply to see the market value of the shares that they own go up in price with an intention to sell in the future. It's very much a long-term operating oriented investment. They are a mining company that's in the business of building and operating and holding mining assets for the long term. Their investment in SURG is building optionality for them to do that. Don't think they don't view it as one of these things where it's like if the share price gets to some level, they're going to liquidate and move on. They don't have a portfolio of similar things, so their investment in this type of thing is really around assessing it as from a kind of build, own, operate type perspective. And I think importantly, again, words have meaning and matter. So when I use the term strategic investor, like that signals to investors a few things, and there's kind of two sides to it. On the positive side, it's like there's a validation, endorsement. Obviously, a highly technical group has run the ruler over stuff and come to a determination. But there's also agreements that come in that come along with these sorts of strategic investments. That if we had a similar sized investment from a purely financial counterparty, you wouldn't expect to see the same agreement or rights being granted to that party, but you often do in these, quote unquote, strategic investments where the counterparty negotiates for protections, in some cases, first look type rights, that sort of thing. So I think the term strategic investor is really meant to communicate and signal those sorts of things. It's like there's things that fall into both the positive and maybe less than positive bucket with regards to validation on the positive side, technical support, all that stuff. But yeah, you're also granting some unique rights to a counterparty that you wouldn't otherwise see or be doing with a purely financial investor.
I do kind of get it from their perspective, I suppose. But what about from your perspective? What are the synergies that you would have having them on as a strategic as opposed to someone else?
Yeah, I mean, they are a company with a balance sheet and free cash flow generation that is in the. I'm repeating myself here, but they're in the business of building and operating mines. So if take for example our flagship asset at Berg, if it ultimately gets to a construction decision, they're the type of group that could be involved at really any level of ownership. And there's lots of ways to structure these things, and we can get into the weeds on that if you want. But they're the type of group that can be brought to bear in terms of providing balance sheet depth and relationships with many of their operating partners that they have in their business. So if you look into the details of how they operate their assets in South Africa, effectively all of them are in joint venture with a wide array of multinational mining enterprises, the likes of Glencore, Norilsk, Anglo over different periods of time, etc. Vale over different periods of time, that sort of thing. So lots of relationships there, a lot of familiarity with building things in partnership. These sorts of big porphyry copper mines, they are frequently done in joint ventures, right? If you look at the asset level ownership of a lot of these big copper mines, whether you're talking about the ones in BC or Chile or wherever, you often see one or more mining companies, maybe like an offtake partner, a company that operates smelters in Asia, that sort of thing. So again, they're the type of group that could very logically and easily fit into that kind of mix, either directly or through their ownership in the Topco. Now that's down the road, right? Right now, the ownership around Berg is very simple. SURG owns 100% of it. They own 20% of SURG. They're providing financial and kind of strategic or technical support to what they're doing. I think in a more nuanced fashion, though, like they're the type of group that could back SURG into really interesting corporate development opportunities that may arise for us in the future, where more special situation type things where the type of capital outlay is maybe significantly smaller than what I'm talking about for the greenfield development of something like Berg. Something like Berg would the usual way these things are financed would be big corporate finance, big project finance facility. JV equity comes in. If you look at what Hudbay just did at Copper World, they sold 30% of that development project to Mitsubishi for a big number. So I think they're bringing in 600 million for themselves, and then that party will continue to contribute their pro rata capital. So there's lots of sort of standard ways in which these big capital nuts are ultimately whittled down through project level debt, maybe something like a mezzanine type product like a stream or a royalty, partnership JV type stuff, and then kind of ultimately the partners are contributing equity. So that's the case for Berg, but we may have other types of opportunities that arise for us that are of a more special situation type nature, where it's more rifle shot, smaller chunks of capital, but they would be opportunities that would see us, maybe acquire more mature but smaller assets. And from the ARM perspective, it's the type of thing where they would derive a lot of value from it in terms of being able to leverage SURG as a vehicle to acquire something interesting like that in a jurisdiction that they do not operate in, and vice versa. We would derive a lot of value from it in terms of that backing, that financial and operating experience type backing. And in that realm, I draw a very distinct comparison against what probably a lot of people in this industry are more familiar with when they look at strategic investments, which is these bigger counterparties, like in the gold space, Agnico is really well known for this. In the copper space, Teck is really well known for this. So these big, industry leaders in Canada who make strategic investments in a much more kind of portfolio broad sense, where they are investing these kind of chunks of capital across like a dozen of these things. And there may be some rights involved there. There's obviously, technical committees and pro rata participation and what have you. But there's also a pretty long history of divestments as well. So they've kind of seen these things grow up into their own thing. So I mean, Orlo is a very successful example of this in the case of Agnico. Recently, they made a pretty substantial divestment of a position that was quite successful for them. And so, yeah, I think those bigger companies that are doing this on a portfolio basis, I think the relationship between the junior and that parent company or that larger company is a little bit different than I think what we are aiming for and ultimately experiencing with ARM, which is a pretty honest exchange of strategic value. Like we're able to bring strategic opportunities and insights to them with a Canadian lens, and vice versa. They're able to bring to us, kind of explicit balance sheet depth on a look through basis, and credibility when it comes to operating capabilities that are maybe not as readily apparent when you just kind of look at what Surge is today as a junior mining company that's pursuing, a pre-feasibility on a big porphyry copper project.
Theoretically, hypothetically forward-looking, speculative and all that, but would Canada be happy with potentially giving, potential control of such a large asset within a strategic commodity to a South African or just a non-Canadian company in this case?
Well, Anglo American has deep South African roots, and they're in the process of merging with Teck. So, yeah, I don't see why not. I mean, to be clear, well, I don't think you can be clear on this. It's all a bit murky, but I think the recent history with regards to Investment Canada reviews around these types of things, like change of control transactions with foreign buyers for mining companies, it's really been Chinese buyers that have been stymied. And I think that's kind of where the line has been drawn. I suspect if Norilsk tried to buy assets in Sudbury or something, they'd probably run into some trouble as well. But no, those sorts of things are not happening. So most of what we've seen recently is Chinese SOEs making either change of control offers for Canadian companies with assets abroad, or even strategic investments, sort of minority 10 to 20% stakes for Canadian companies with assets abroad. And a number of those have either been, blocked outright or just sort of stalemated in a way in the process. But all of that was in the Justin Trudeau era, and so the world has changed in a big way. So I don't see this being an issue for us at all.
Does having them at 19.9%, which I guess is not a backing, it's not a blocking interest in there, but does having them in there for almost 20% now, does that mean there's no room for others, or could there be room for other strategics for future financings?
The answer to that is yes. There's absolutely could be room for others, and our board thought long and carefully about this. So the way to think about it is like the reason for the 19.9% threshold is that's kind of Canadian securities laws or corporate laws. If you go above 19.9%, you're obliged to make an offer to like all shareholders. So that's kind of the practical limit before there's a creation of a control person, and there needs to be a bunch of steps taken to either get shareholder approval to do that, or make a takeover bid for the whole company. So that's the kind of reason for that 19.9%. I'm just speaking in generic terms, not specifically about Surge here, but in generic terms, if you have a company with a 19.9% shareholder and the thing evolves in such a way that there is a third, bidder that comes in, a third group that comes in and is, offering a price and a transaction structure and terms that are like attractive to all shareholders, these sorts of things they're not de facto blocking stakes. So this is going to get into a little bit of M&A mechanics in Canada, but the way it works in Canada is, you do what are called plan of arrangement transactions in most cases, which is they're all or nothing transactions predicated on the approval of 66 and 2/3 approval of all the shares that are being voted. So in theory, if you have really large turnout at a shareholder vote for an M&A transaction, you need 66 and 2/3%, not of the whole 100, but not of the whole pie, but of just the portion of the pie that turns up. And if you get that, if you cross that threshold, then it's compulsory that kind of everything gets sort of put into that transaction. So, if you had a 19.9% shareholder that was not, that was like against that transaction and not going to vote in favor of it, that's a pretty high hurdle to cross, but it's not a de facto blocking stake. It may be perceived as a, for all intents and purposes, blocking stake, but that just sort of raises the bar of, if a bidder wants to kind of acquire control of something, it just means they have to win over that shareholder, or it kind of raises the bar, but it's not a de facto blocking stake. Bringing it back to the Surge case, though, I think part of how the board got comfortable with this is that, again, these types of assets are usually not built in by a single party. It's a little bit different than the dynamics you see in for example, the gold space, where a lot of gold mines are, relatively smaller capital outlays. They are the types of things that usually companies are able to finance off their own balance sheets. And there's just kind of a cultural business preference in the gold space for companies to kind of do things themselves. You don't see a lot of JVs in the gold space. There's like historical reasons for that, cultural reasons, and I think just the kind of relative size of the assets allows for that flexibility. Copper is a fair bit different. It's again probably primarily driven by the size of the capital outlays, but there's just a historical evolution there where a lot of the companies involved and a lot of the assets over time have been built in joint venture type structures. So you go through the whole list of like these big global porphyry copper mines, and many of them, not all of them, but many of them will have JV structures attached to them. And you'll usually see like an offtake partner, a state-owned entity, or one or more mining, or two or more mining companies attached to them in some cases. And so, I think in that case here, like our perspective is, ARM have come to the table. They've been great supporters of this thing. They've earned a seat there, and through the Surge structure. And if the Berg asset, if the Berg deposit ultimately finds its way to a construction decision and a JV consortium is sort of put around it, I don't think any parties coming into that would see ARM as a prospective JV partner as something to be avoided. It's quite the opposite. They're a great partner to have, and again can bring balance sheet strength and lots of kind of knowledge and expertise to the table. So I think combination of all those things, we did not see it as something that is going to cause a lot of friction in the future in terms of the competitive playing field around a future M&A scenario. And quite to the opposite, gives us a lot of optionality as we push things forward. Like we may want to take this forward to a certain degree in the future, where having a kind of in the tent, deep-pocketed partner that can just sort of help get this thing as far down the road as possible is on balance definitely in our favor.
I do want to talk about the proceeds from this investment as well. You set out for 6.4 at first, ended up getting 10.5. if I'm not mistaken. What's the what are you going to do with the money? What's the split going to be in terms of drilling versus other stuff? And then within the drilling, what do you want to spend the most money on drilling?
Yeah, so to be clear, the deposit is pretty advanced from a drilling perspective. So and that's kind of been the case at Berg for a while. So we haven't been in this sort of realm where we are financing 30,000 meter drill programs. We're kind of getting into the engineering phase of things where drilling is important, but the size of the programs is not quite there. So, for example, as I mentioned at the top, what we were doing this year was a lot of like geotech and geochem drilling. So the kind of scale of meterage is not up there. I mean, as we get to feasibility, for sure, there's going to be some campaigns probably for larger diameter like metallurgical core drilling, lots more geotech drilling, et cetera. So that will come. But what was required for the PFS was not huge. Like I've made this point before, undoubtedly, but the mineral inventory in the PEA, so the portion contained in the pit, which I often think of as the target for a reserve, the proportion of that was already in the measured and indicated categories in the PEA was pretty high, 80%. So coming out of the PEA, we didn't need to do lots and lots of drilling to upgrade an inferred resource to measured and indicated. It was much more modest than that, and also simplistically, because we've got like a single deposit, single open pit, there's a lot of you can double up on a lot of stuff. You can be smart with how you design drill holes so that you're achieving multiple objectives, where a drill hole is traversing the ore body and achieving a bunch of like infill conversion drilling, but also getting useful material for met test work, getting useful material for geochem work, piercing the ultimate, pit wall boundaries so you can use it for geotech, et cetera. So, aggregate meterage for us has been, we've kept that contained as a result of just smart planning and just some, good benefits of where the deposit was at. But yeah, to get to your question, probably 70% of that proceeds is going directly to the field program that we just completed and the finalization of the PFS. So, costs specifically related to the delivery of the pre-feasibility study. So we will see that ultimately deployed by the kind of end of the first half of next year. And then the other kind of 30% roughly of the proceeds is a corporate runway buffer and kind of direct kind of budgeted allocation towards EA preparedness. But a lot of that stuff is it's sort of agreement negotiation. It's really a lot of soft costs. It's hard to necessarily pinpoint exactly what's going to go into that. I think once you get into EA, that's more there's more heavy lifting around environmental consultants and field work to deliver the goods on that. But for what we need to complete between now and entering the EA process, a lot of those costs would be earmarked for legal advisors, environmental consultants,
the fun stuff,
travel, just stuff like that, relationship type work around that.
But so no immediate plan for like a large step out or exploration drilling program where you're, essentially, I hear it as an argument a lot, where people we're trying to defeat the Lassonde curve essentially, because you're going to come into that, throat of the Lassonde curve there. And the way some people try to defeat it is by making new discoveries. So yeah, as far as I'm hearing it here, no plans to, go looking for new discoveries in the meantime then.
I wouldn't agree with that. No, it's just a matter of prioritization, ranking, and sensitivity around dilution effectively. So SURG has, I think, a really excellent pipeline of exploration opportunities in our district. And if you look at our website and some of the kind of key press releases we've put out over the last few years around this, it's kind of the bucket that we refer to as regional exploration. You can see some of the kind of key investments we've made in this area, and it's all of a systematic nature. So we have, done really big campaigns around airborne EM data gathering, and then followed that up with, multiple campaigns of ground-based, soil surveys, ground-based geophysical surveys, IP, and the like, to kind of identify and advance targets through that kind of funnel of getting them up to a drill-ready status, and then doing campaigns of like target drilling on some of these targets. It's limited to like 1 hole, some are 3 holes, some are 6 holes, that kind of thing. So we've had a number of I would say every season we are doing a little bit of this. It's some seasons it's been a big focus, and we've had programs on the kind of regional recon work that are on the order of 10,000 meters. Other years it's like much smaller than that, like less than 1,000 meters. But in the background, what that's done for us is it's kind of like built this optionality, and it's built this pipeline that has kind of slowly been progressing. And the strategic purpose of that is kind of what you're saying. It is to sort of give balance to that. To use for lack of a better term, the kind of Lazan curve dynamics. And so, if we are going to be spending the next couple of years at Berg doing some heavy lifting on geotech, metallurgy, permitting type stuff, there's absolutely, I think, a strong argument to be made that, okay, well, while you're doing that, and while the kind of picture of value around Berg is kind of stabilized, you've put out a pretty definitive marker on value in the form of a preliminary feasibility study, and you're not like doubling the size of the resource or whatever. While that's the case, it's like it's smart value creation to kind of go and use part of your financial and human resources during the field seasons to try and advance some of the earlier stage, higher risk, high reward type stuff. So we absolutely will be doing some of that. It's not as if we've put out any clear guidance on that recently on what the pipeline of that will be, but part of that is because the picture hasn't changed in the last couple of years. It's like the pipeline, the pyramid looks the same as it did a couple of years ago, and it's targets like Burgett, Sylvia, Cibola. We've got some like completely undrill tested geophysical targets from a ZTEM survey we did a few years ago that are, again, they're not drill ready. There's more surface work to do, but I fully expect that we'll see some of that work advanced in the coming year or two. I'm not going to give any guidance on the size of programs or budget. It's totally down to cost of capital. So to tie this back to valuation and dilution, it's like, I think myself and the board is of the view that SURG is very undervalued. And so like running out to go and raise order of magnitude $10 million for this type of use, it's hard to make that, like, I don't think we would lean in favor of that decision at our current valuation, but at a much higher valuation, the higher the valuation, the easier it becomes to make that decision. It's all about, are we diluting our shareholders' interest in Berg for the purpose of rolling the dice on a much riskier bet? And yeah, it's just there's that kind of constant tension and interplay. So I think we've been prudent about it over the last few years, where when we've had the ability to raise bigger amounts of money from a price and market conditions perspective, we've allocated some good, we've done some good programs on making these like long-term investments on big recon data sets. We've kind of pushed things forward slowly but surely on the target drilling side of things, and that's built for us a good amount of optionality to strike when the market conditions permit to really advance those types of things. And and like when you're in the field, you've got fixed costs, right? So we will be in the field every year for sure, because we're advancing a project through feasibility. Like you have to be out there doing environmental baseline. Like there's always going to be stuff going on at Berg. So we'll have like a fixed cost around that. And so it's a question of, oh, can we add, 10, 15, 20% to the field budget to have some targeted work done on advancing, key high priority exploration targets. That's kind of always been our philosophy, and we have done that every year, and that will continue.
What about in terms of timing? How long do you think you're not going to have to raise capital for?
So the 10.4 million that we raised, I guess, plus where our treasury was at the time, which is around $1 million, will give us runway to the end of next year, strictly on the kind of Berg deliverables around PFS and EA readiness. So, I think if we wanted to do like a much bigger campaign next year around like the heavy lifting, like higher cost stuff around drilling, whether that's at the Berg deposit or regional type stuff, we would need to top up before then, but that's not a definitive, like we may not decide to do that as well.
Mm-hmm. Do you think come time to do it, is there room for, maybe you can remind me actually what percentage of the revenue is from precious metals right now, and come time for you to raise capital, would there be room for streamers?
So the percentage revenue from the precious metals in the PEA, I mean, we'll talk about this, I'm sure, but the metal prices are way out of date, particularly for those metals. So I think it was like 12% was the revenue contribution from silver and gold. I think if you run like either spot prices or something approximating what would be sensible long-term prices in today's environment, that number goes up. It's not a crazy increase. It probably goes from like 12% to like 15 or 17%, something like that. Mm-hmm. So this is still very much a copper moly project, to be sure, but there's a nice little byproduct there around the precious metals. My philosophy on that stuff is, selling streams and royalties. That's like you can kind of do it once. And you're going to get the biggest bang for your buck if it's part of a project financing type thing. And like I think these types of projects, like we're in the business of advancing this using risk capital, and ultimately, I think a very common outcome for these things is a change of control M&A type transaction. I'm not saying that's our objective here, but that's just speaking in general terms, that's like a common outcome for these types of projects. And so it would be a little bit illogical for us to impair that, to make that outcome less likely by impairing the asset with a cumbersome royalty or stream prematurely. And without naming names, there are absolutely assets out there today that have that effect to them, right? Where it's a good project, good asset, sold royalties and streams too early, and probably impacted the ability for the project to find an ultimate home or a buyer. And maybe if it ever does, the stream or royalty will need to be restructured anyways. So I think there's a bit of a history of that kind of thing happening in the mining space. And so again, at a super high level, bit of a keeping things very general, I think I think if you want to sell a royalty or a stream, doing so toward the end of the arc before you get to a construction decision, like the later you do that, the better, in terms of knowing what the ultimate like ownership sponsor group is going to look like, knowing what the project financing pool is going to look like. I think it can fit in very well as a project financing tool. But we're not at that stage yet. So why would we give away a project financing tool in the toolkit simply to fund higher risk earlier stage stuff? I'm just of a view that stuff is better done by risk capital partners early on. That being said, there's a lot of kind of like hybrid solutions that we've seen where some of these royalty and stream finance providers take equity in exchange for rights of first refusal, rights of first offer on those sorts of things. And yeah, those are good instruments, right? Like getting sort of an equity investment from one of these partners or one of these players in exchange for saying, hey, if we ever do a stream or royalty, you'll have first kick of the can. That's a very fair and attractive thing for a project at this stage.
Yeah. I think you and I would have spoken about this last time, but please remind me what the change in control fees here are.
So it's for the named executive officers, which is like the management team, 4 individuals. It's going to be different for each person, but per the terms in their either employment contract or consulting contract, or just whatever the like minimum statutes are for, not for change of control, but for like termination provisions. It'll be sort of a multiple of their annual income, both on the base salary and kind of bonus. So again, I don't have all these memorized or in front of me, but order of magnitude, it's going to be like, whatever an individual was paid in the last 12 months salary and bonus, it would be sort of like 1x that. So, they basically get paid a year of what they were previously earning as a change of control. And then, unvested RSUs, DSUs, et cetera, vest essentially. So, which is, both of those things are lock standard and pretty fair, right? Like in the case of a change of control, you're losing your job, and so it's a bit of a kind of normal severance package, unless of course you're like going on. Like sometimes there's change of controls that aren't really change of controls. You're sort of like doing an MOE or something, and the board changes, but the CEO stays the same. Like there's obviously like exceptions to these things, but yeah, it's sort of a severance in terms of like cash that you've been earning for the last year. And then, the point of RSUs and DSUs, it's like they are like long-term incentivization securities, right? So it's like to incent people to stay in the seat. And so if the company is deciding that you can't stay in your seat anymore because we're doing a transaction that's in the best interests of shareholders, well, I think it makes complete sense that those securities would vest, and you would treat them as if they were owned as stock. You obviously have to pay tax on them and what have you, but yeah.
I agree. Not on the tax thing, but I do agree about you deserving a change in control fee there. What I'm really checking for here, Leif, just a bit of a background, is I'm a firm believer of incentive being one of the most important concepts in finance, and so it's essentially trying to see, what drives you. I do think the value of your equity would be higher at that point, so that's essentially what I'm checking for here, and that's why I'm asking about a change in control fee. You had mentioned that your field program would run up to late September, so I assume it's done now. You said 5,000 meters. How did it go? What did you get done? Where was that 5,000 meters? Talk to me more about that.
Yeah, it went very well. So there was 4 holes drilled into the Berg deposit for resource conversion infill purposes. And those were, like we've got a long-ish inventory of planned holes for these purposes, and it's just a matter of moving down the priority list and kind of ticking these things off as we go. Part of it is where in the deposit we need to infill, like where the inferred blocks are, where et cetera. Part of it is like pad construction, logistical considerations, the costs and just sort of challenges around building new pads and kind of permit constraints around that. So for each year over the last 3 years, we've done a fair bit of this, advancing the infill drilling work, and that's kind of how we go through the list. This year we did. So what I mean by environmental geochem drilling, that is again simplifying a bit, it's like drilling into the waste rock in the pit. So we've got a known volumetric envelope in the form of an engineered pit shape. There's a block model that sits within that pit shape, and then kind of everything outside of the block model that's in that pit shape is deemed waste or considered to be waste. In most cases, it doesn't have a lot of drilling into it, right? That's you're theorizing that it's waste because it hasn't been drilled, and it's, the grade is kind of diminishing as you approach the margins of the deposit. And so, but over time, that waste envelope will get more drilling into it for both geotech and geochem purposes. And there's, of course, the chance of upside surprises in the form of discovering new zones, hitting distal veins, things like that. So, but simplistically, like, the waste envelope in the deposit is something that when you excavate it, when you extract that, you got to put that waste somewhere. You're either going to put it into a waste pile, or it's got to go into the tailings facility. And the differentiating characteristic there is whether it's potentially acid generating or not. So it just has to do with, sulfur abundance in the rock. And so you got to put some drill holes into it to understand that, model the kind of sulfur in the rock. And again, it's relatively simple with these big porphyry systems. You've got a big pyrite halo, and so if you're out of the ore zone but in the pyrite halo, 9 times out of 10 that's going to be potentially acid generating rock. And then at some point you get out of the pyrite halo and it's non-acid generating rock. So it's really just about kind of putting in some drill holes to characterize the shape of that boundary, and just characterize how it kind of attenuates over radially as you move out. And so we've done over many years a bunch of surface work to characterize that. And last year when we were doing geotech drilling, that was a lot of stuff in the margins of the deposit and moving into the outer reaches of the pit. But a lot of that was angled drilling. It was pointing down to hit the pit rim at a 90-degree angle effectively. And so you're missing a lot of that, like, large volume waste that kind of sits in the upper portions of the pit cone. And so this year we went back and did some dedicated drilling into that waste envelope. And we attempted to do something that we thought was going to be much more cost effective and efficient, which was using underground rigs secured against the berg. Has a bit of a pit shape to it already. We see that on a lot of imagery that we put out. But so we got drill roads along the hill, and we were drilling into this waste envelope, which, because of the erosional profile of the berg deposit, because the deposit kind of sits in what looks like a cone-shaped depression or hillside already, drilling into the waste is actually an uphill exercise. You're drilling up the slope, and so we used underground drill rigs anchored to these drill pads on the side of the hill, and the angle of the drill hole itself was going up, basically, so negative angle drilling. And we completed 4 holes successfully of that method, but it was hard work. Like, I think there's just a lot of technical challenges with executing it. So I think for future data collection in that realm, like, there will need to be more of this before you get to the end of the feasibility road. I think we'll probably do some helicopter supported drilling where you bring a rig up to the top of the hill and drill down instead of up. It'll probably end up on balance being cheaper, even though you're using a helicopter to do that. But anyways, for that program, we had some good success, got the core we needed, got the data we needed. It's in the laboratory now doing the geochem humidity cell tests and whatnot. And then the final piece was geotechnical drilling in the infrastructure area of the project. So last year we had a geotech program in the pit. So that was, as I said, intersecting the final pit shell to understand, to do some tests and understand rock mechanics at that at the kind of final pit limits. Same thing has to be done along the whole corridor and the whole area where you're going to be building, the mill foundation, the conveyor route, where the camp will ultimately go, et cetera. So we just acquired a bunch of the tenements that underlies that area in the last year. So this was the first year that we were able to actually do drilling on that ground. So we had about a dozen holes completed this year for that portion of the program. These are much shallower holes because we're not investigating anything to do with a ore deposit. It's all about estimating or learning about the bedrock in an area where you're just going to be building stuff at surface. So you want to know how deep the bedrock is, and then you want to drill a few meters into the bedrock to know if it's, all fractured up and what have you. And so in this particular area, it's like, yeah, you got till cover that ranges from a few meters to a few tens of meters, and then you're drilling a few meters into that bedrock. And we didn't see any surprises. Like the depth of that till cover was as expected. And so the depth of most of these holes was like on the order of 50 to 75 meters. So, a dozen of those holes to get to like, whatever, thousand plus meters of that type of drilling. So yeah, lots of data, lots of, I guess, important, impactful stuff for pre-feasibility engineering work. But because of the different use cases, that's why the total isn't, tens of thousands of meters. It wasn't a campaign of dozens of infill holes into the deposit itself. As a result, the news flow coming out of this stuff, which should start here pretty soon, we'll obviously have a couple press releases about those infill holes in particular that highlights the grade in some interesting areas of the deposit that are 200-meter infills, that kind of thing. So it's impactful stuff. And then in parallel with that, there was a resampling campaign done on some historical core from the center of the deposit. So the kind of spatial center of the deposit is Berg is a bit of a donut-shaped mineralized zone. So you have an intrusive stock in the middle, and then veins developed into the surrounding wall rock. So most of the metal sits in the that kind of vein envelope in the wall rock, but the intrusive stock in the middle is mineralized as well, but it's like it's weakly mineralized, so it's not the juicy stuff. And as a result, a lot of the historical drilling done at Berg in the early days of it being drilled out, for obvious reasons, when you're doing exploration, you're chasing ore, you're chasing economic mineralization. So a lot of the drill density is in that donut, and you've got comparatively less drill density in the center. And a lot of that historical stuff was, like the QA/QC history around it, the assaying for precious metals. A lot of that stuff has just changed over the years, and so I think a lot of these drill holes are used in our current resource estimate for grade estimation. So you've got above cutoff grade mineralized material in that center of the donut, but for categorization purposes, like whether the QP says it's going to meet the criteria to be inferred, indicated, or measured, it's categorized as inferred because of the QA/QC type stuff. And so we've gone through and resampled a bunch of that stuff this year. I think it was like 20 holes, 18, 17 to 20 holes. I don't know the exact number off the top of my head. But yeah, easy, low cost work. Go find this stuff in the core yard, quarter the core, have it reassayed. We get some new data for silver and gold that may not have been there from the old stuff, and we get to revalidate the QA/QC under modern standards, and it kind of will meet that criteria for categorization. So it's for purposes of infill drilling or inferred conversion, it's equivalent to drilling those same holes as if we did it this year from scratch. So we're going to get some big impact from that in terms of inferred conversion, and all of that matters for a PFS, because if it stays inferred, it's treated as waste in a PFS, which obviously you don't want, right? Like if it's above cutoff, it's there, especially if it's like very obviously in the mine plan, it's kind of like in the middle of the pit. You want that to be treated as what will be called ore once we deliver the PFS.
You said a lot of data is about to come through here sometime soon. What does that mean for your news release cadence? When will some assays start coming in from that? And then how long are you going to have news for, essentially?
Yeah, I mean, I think most of the assay stuff will be delivered before the end of the year. It's all kind of coming in batches now. So for this type of stuff, batching it will be a function of clear communication. I don't think any of this stuff is material. So we're not trying to drip feed stuff out. It'll be like, how do we batch this so that it is like a coherent, story to tell, or, kind of bit of information. So as I said, 4 infill holes, and then 17, 18, resampled batches of core. So we'll get all that data in and figure out how it all ties together and put that out in maybe a couple press releases this fall. I think the laboratory work that's going to be going on the geotech and geochem stuff will take more time. So if there's newsworthy summaries of any of that to come out, that'll be maybe into the new year. And then, I think that's potentially it, right? Like obviously the huge catalyst coming up is the delivery of the PFS. So there isn't it's a little bit down to our discretion if we wanted to put out just general updates that I think help to kind of lead people in the direction that we're going. We obviously will. We may choose to do that a couple of times between now and the delivery of the PFS to just sort of say, here's how things are going. Here's how the information has changed from before to where it is, and what the PFS is trying to achieve, as opposed to just kind of flopping the whole thing out at the end. So, but yeah, the big, all of this is in service of delivering the pre-feasibility study, which is kind of the big one, which will be targeting first half of next year. The sooner the better, the earlier the better, obviously.
Yeah, I was wondering if that timeline has changed, but first half of 2026. So it's not changed. That's good. Why would I own the stock in the meantime? It's kind of the question here. Though, if I didn't own it today, and you're entering what some people would call the boring part of the Lassonde curve. How do you create excitement, I suppose, or how do you close that valuation gap? That might be a better question. I know it's too many questions that I'm asking, but I'm trying to make it sound like I'm smarter than I really am here. So give me some rope. But people will say this is the most undervalued copper developer out there. Why is that the case? How do you close it? And essentially that goes back to what I just said. Like, why would I own the stock between now and the PFS if again you say that there's not major catalysts or anything like that?
Yeah, I mean, excitement and news releases do not equate to value, as right? Like they're a communication. News releases and catalysts are a communication element around like the value creation process. But I think the question you're asking is also, you're describing the psychology of a lot of investors, speculators, as you like to call them, in our industry, which is like people trying to time the market to the nth degree, right? Like I'm gonna park my money here for this week because I'm expecting this news release that's misunderstood by the market. I know it better than the market does, so there's going to be a pop there, and then I'm immediately going to go park it somewhere else. And so it's this kind of like perceived investor psychology that people can lily pad hop throughout the calendar of catalyst events from a bunch of mining companies. I don't know how well that works across the business as a whole. There's probably some very talented individuals that can do that, but I don't know. My attitude on these things is I take a much longer term view, which is that we're doing something in the mining space here that is pretty vanilla. It's pretty like we're working in a commodity environment that's obviously got bullish fundamentals. We're doing the very obvious quality work that you need to do to de-risk these things, to surface value. De-risking is also like that comes through in the form of like multiple re-rating or reductions in discount rate, however you want to like theorize what that means. It's like if you have something that's trading at like 1% of NPV right now, and you go and deliver a bunch of like real scientific work that shows, all these assumptions are actually pretty good assumptions. Like this is less risky than we are de-risking it. We are reducing the risk in what's going on. there's just like logical, there's finance logic to suggest that 1% of NPV should just like increase over time to 2, 3, 4, 5, 10% of NPV. So I think that's kind of the very simple pitch to investors here for Surge is that, hey, we're a good project. It's always been good. I think maybe the recognition of how good it is changing in real time. That's probably why our share price has done pretty well. We've outperformed a handful of peers, really relevant close peers to us in the last year. So there's raised awareness over how the quality picture around this project, the extent to which it's being de-risked, and yeah, we've got a big catalyst coming up in the form of a snapshot in time study that's going to kind of put a bow around a lot of this stuff. So yeah, like why own it between now and then? I mean, torque to just like macro stuff going on, I guess. Like why own any copper stock between catalysts? Because you never know when these re-ratings come. You never know when the market's gonna move on these things. And yeah, we're objectively very cheap versus a bunch of comparative things. So that's a message I've had for a while. The stock has done pretty well in the last year, but there's still a huge gap between us and where I think some of our really logical peers are, right? Like projects that are at this kind of level of de-risking that have a lot of the fundamental ingredients in place. I'd also say like on the BC side, yeah, like permitting in BC is like, I'm not saying anything that people don't already know. The like unique aspects of BC as a jurisdiction for copper development are squarely around the permitting topic, right? A lot of these projects are in fact lower risk technically than other parts of the world, but I think there's an investor perception, quite rightly so, that there's unique challenges or unique complexities around permitting. So as a company, we're very focused on advancing that piece of the puzzle. Like it's great to see the government and Canadian society as a whole starting to respect and understand the importance of these types of things. But we got the rubber has to hit the road for us in terms of actually getting into the EA process, actually getting some concrete understanding around timelines, and we have aspirations to really deliver some positive outcomes there around bringing First Nations partners into the fold there, and just kind of showing a very clear pathway to how we're going to kind of move through the EA process. It is fundamentally different than what you see in other jurisdictions, but I don't see it as a negative. It's more complicated, but it doesn't mean it's like riskier. It's just it's, I think, not well understood, and it's evolving. But I think the way it's evolving is in favor of big important projects that are being pushed forward in the right way. And so yeah, so that's another bunch of catalysts that going back to your question of why own the stock between now and then. Well, we're working on that stuff right now too. I'm not going to give any promises or guidance around timeline of delivery of catalysts around the permitting square, but ourselves and all of our competitors in BC are working away on this stuff, trying to advance relations with the government and First Nation stakeholders to try and kind of put these projects in the right pathway, so to speak. So there may very well be some material value creation events around that as well, I would say.
And there's BC and then there's BC, right? I mean, there's the Golden Triangle and then there's Southern BC. Maybe you can talk to me or help me better understand how that changes things for you. Is it, I mean, either in terms of permitting or community or in terms of, I know that like seasonality is less pronounced in Southern BC. But what else is different? Are there any specific challenges to Southern BC as opposed to, we'll call it the Golden Triangle or the northern part of the province?
Yeah, so I will just, and I know you did a great tour around the province, so I don't want to suggest you don't understand the geography, but southern BC to me would mean like down by like Kamloops and like the very far south of the province. I
Yeah.
would say Smithers and kind of where we are is central to northern BC, but it's very much in the kind of interior of the province that has a lot of infrastructure, pretty mundane topography. Like it's pretty easy to get around. And I like to me that's the big contrast with the Golden Triangle, which is like the Golden Triangle is like deep into the coast mountains. It's very rugged. There isn't a lot of infrastructure in place there, but it's always been known as obviously extremely geologically prospective. And I think we're in a period of time right now where there's been some big discoveries made there over the last 20 years. Been a couple successful mine builds, and the political lens with the Tahltan Nation has progressed really successfully, and so it's like a really unique area of BC, kind of because of all those ingredients, like really epic geology and prospectivity, really tough environment from a infrastructure perspective, and probably one of the like it's got a unique lens around it because you're dealing with a like a single indigenous nation that has very deep capacity. They're quite sophisticated. They kind of know what they're doing and how to do it, and they know what they want, and so it works really well there. And so I think it's a area that is winning a lot of investment, around exploration. But the flip side of that is like the hurdle rate is super high, especially for copper. For gold, less so. I mean, gold, you can build gold mines anywhere in the world because you can, you got to get your kit in there once, and then once you got a mine going, you can fly your bullion out with or your doré out with a chopper. With copper, it's obviously very different. You need trucks or railroads or whatever to move your thousands of tons of concentrate out on a daily basis, or weekly basis. So yeah, when you look at the actual practicality around building base metal copper mines in the deep Golden Triangle, the challenges around them are really all down to infrastructure. Like, how do you get a road into these things? How do you get power into them? And it's really a function of how deep you are. Like KSM is in the process of really, it's kind of breaking through the
Mhm.
threshold right now, but they're kind of like right at the threshold, or right at the start of the deep into the mountains, and you compare that to like Galore or whatever, which is way in there. So you just sort of look at these things on a map, and you can kind of tell based on like how deep into the mountains you are. Is like the deeper you are, the more difficult it's going to be for just obvious infrastructure reasons. I think where we are is yeah, I don't want to. It's a little bit semantics, but we're not southern BC. There is. I just want to make that clear. It's kind of like the northern part of the central BC interior, and kind of somewhat analogous to KSM. We're not like deep into the mountains. It's sort of like the very front, the first one of the first ranges there. So access is pretty easy. The prospect of building big mine scale infrastructure, whether you're talking about roads or power lines, is very tangible. Doesn't mean it's cheap or easy or free, whatever. You're still talking about, building roads into the wilderness, but the scales involved are like orders of magnitude less and much easier than what you would be contending with in deep into the Golden Triangle. So that to me is like the fundamental difference is like access to infrastructure is kind of the number one thing. And then yeah, like the First Nations lens as well is quite a bit different elsewhere in the province. So you have usually kind of overlapping title claims. So multiple Indigenous nations or Treaty First Nations bands that will have title claims, traditional territory maps, boundaries, et cetera, that overlap with one another. And so you're dealing with overlapping title claims in particular geographical locations. I think in the Golden Triangle, that picture is quite a bit simpler because you're dealing with one one party. So the complexity for groups like us, in many cases, boils down to like, and we're not alone in this picture. It's like all across BC is like this, and frankly elsewhere in Canada as well. But yeah, the picture boils down to advancing things in parallel or together with kind of multiple different groups like that.
Yeah. Yeah. When I said southern BC, I suppose I was thinking just to the south of where I went in the Golden Triangle.
Yeah.
And that's just an excuse for not looking too stupid on camera. But are you guiding any numbers for the MPV and CapEx at the current metals prices, or whatever prices you might end up using for the PFS? I mean, how much of a difference are we talking about? I mean, clearly, as I mentioned at the beginning, there is some difference, but how big of a difference are we talking about?
Yeah, I mean I'll try to simplify this for the investor audience. So yeah, like when you put out these studies, part of the requirements under 43-101 is like the sensitivity tables. So you kind of show how, for each 10% change in one of the revenue inputs, metal prices, how fast does the NPV change? So we have that disclosure in our presentation, front and center as it relates to the main metals, copper and moly anyways. And so, yeah, like those are basically linear changes. So you can kind of just see like, okay, for every like 10 cent or 20 cent change in copper price or dollar change in moly price, whatever it is, here's how the NPV changes. So you can kind of do the math and say, well, if all else equal, if you were kind of running the PEA at spot prices, or I don't know, pick what you think might be sensible long-term metal prices for those things today. Certainly, I don't think $5 is the right thing for copper. Probably, $4.25, $4.35, something like that. Moly, on the other hand, has like been very sticky between 20 and $30, and virtually every study out there, from bigger companies to smaller companies that have moly involved in it, I haven't seen anything below 20. So I think 20 is a safe floor for something like that. Yeah. And then silver and gold had been, I mean, they're like more than double where we were 3 years ago. So quite interesting movements there. So yeah, you can kind of like piece together that it all else equal in the PA, if like you're just using new metal prices. I mean, I think flip to my presentation here, but I think the like bottom right hand corner for the sensitivity tables on NPV, which is yeah, I mean it's like 520 copper and 1950 moly. I mean, you're talking about $4 billion NPV and roughly 30% IRR. That doesn't take into consideration the changes in the precious metal prices. So you'd probably get an additional boost there. So 4 and change NPV and probably low 30% IRR. The flip side of the equation is like, again, if there's no design changes from one study to another, how has the cost environment changed? So where has cost inflation gone? And that's certainly not trivial right now. Like, as we all know, no matter where you are in the world today, like we're living through an inflationary period. And so there's absolutely been cost inflation across the board for both, CapEx and OpEx related items. We're like certain aspects of that we're going to be shielded from. Like this is a project where a lot of the power, a lot of like the, energy consumption costs are like hydroelectricity. So you're not like dealing with the same kind of like commodity price swings that you might see with things like steel and I mean, oil is obviously not super high at the moment, but yeah, like the drivers of cost inflation are there's a complicated story there, but there's obviously been you can easily kind of witness cost inflation on realized capital expenditures and realized operating costs for these types of things. So, so I think that's obviously going to pull those numbers back from the upper bookend that I just mentioned from the sensitivity tables. And then the third factor is like, okay, well, what has also fundamentally changed? And so for us, a big one is going to be the metallurgical recovery profile. So we have I guess the way I described this before was the recovery formula we used in the PEA was, we believed it was conservative. I think the results of our PFS MET program have borne that out. We're likely going to see, changes to the recovery profile here on the order of like, 5 percentage points for copper and maybe, 10 plus percentage points for moly, the two biggest credits. So, macro pricing environment aside, that's just like more metal per ton that you're recovering and selling. So kind of big fundamental improvement there. And then also, other physical changes will just be, like design changes. So the resource is going to be bigger. Do we want to make any adjustments to the throughput, to the, we've got more geotechnical knowledge now. Will the phase development of the pit change in a more optimal fashion? Will the mill be located in a slightly different area? Is the conveyor going to be designed slightly different? So there will, like, we're not totally changing anything. It's not like we're going from, an open pit to an underground design or something. It's nothing dramatic like that, but there's lots of changes to the like physical parameters underlying the project that will drive impacts to NPV and IRR as well. So I would say, the bottom end of the bookend is, I think, should hopefully be the PEA numbers. I think we've seen enough like improvements on the macro side. Metal prices have moved higher than the kind of inflationary pressure underneath. Plus, we've delivered some good fundamental improvements. So I think the PEA numbers should be kind of like the bottom bookend, and then just taking the PEA and running much higher metal prices through it will give you a sense of like the upper bookend. And so somewhere in between is kind of where this thing should shake out. We're doing a lot of important trade-offs right now around sizing and kind of phasing of the project. And just simplistically, like this is a deposit that has more than enough mineralized material, and hopefully our maiden reserve declaration will be at that kind of scale as well. Like there will be enough quote unquote ore here to it could justify like a much bigger throughput that is kind of at that Highland Valley type level, or types of throughputs that we see at some bigger mines in Peru or Chile. That's going to drive higher capex, and so we're looking at, well, does it make sense here to look at a phased development, to just sort of have a phase one that's something smaller, maybe even smaller than where the PEA was, and then kind of grow into a bigger throughput, so that you're not talking about a 50-year mine life. You're talking about something that's kind of more akin to where we were at the PEA, sort of 30-year mine life. So no definitive answers on that. I'm kind of, I guess, testing the waters by saying that, but it's a logical thing to be investigating at this stage of a PFS, to sort of ask the question, okay, you've got a bigger resource, what's the right size for something like this? And then once you know the right size, then there's kind of the practical question of, well, what's the right way to build into that size, given you're talking about something big. It's a big mine for sure. So it's not for both. And this isn't really just a statement about access to capital or things like that, trying to minimize capex. It's just risk management, and this is something that even really big companies, they look at it through these lenses as well. So even if this was a project that was owned by one of the biggest mining companies in the world, who has no problem building and operating and making capital investments of this scale, they may still, from a risk management perspective, say, well, it's all else equal. If you're going to have a cost overrun on a capital investment, you'd rather do that on a smaller one. And then once you sort of get everything commissioned and all the kinks worked out, then you can add another comminution line and kind of increase the size. And so there's kind of risk management there. And then it's also kind of community impact. Like you're going to go from a standing start to trucks moving all over the place and huge hiring spree and stuff like that. It's those kinds of impacts are can be significant, and there's a lot of sensibility in just saying, yeah, do we want to ease into it? Is it a prudent plan to ease into it through a sensible phasing scenario, as opposed to just going, full 100% throughput in one kind of 2 or 3 year construction period? So again, no definitive answers on that yet. We're working through some of that stuff for the PFS, but yeah, once we get to that study, we'll obviously have some answers on that.
How did you get that better metallurgy there, though? I mean, moly recoveries are up significantly. What has changed? I mean, did you have to grind it to a smaller size, different reagents, longer? What changed?
Yeah, I would say so a little bit of all that stuff. I mean, not lower grind size. The grind size has been pretty well established here. So it's
160?
more, yeah.
Okay.
So it's which is not particularly fine. I think we talked about that in the last discussion.
Yeah.
But I think it's more to do with like how the prior work was done, and this isn't a criticism of it. It's just sort of a reflection of the practicality of the historical work and the kind of period of time in which it was done and so forth. So the real simple story was one of the prior owners of this project called Terrain Minerals. They did like 3 rounds of metallurgical test work in the 2009, 10, 11 period, I think it was. And this was like roughly in parallel with similar programs that they were doing at Mount Milligan. So those are the 2 projects that they owned. Mount Milligan was in feasibility. Berg was like pre-scoping, basically. And so they had like pretty advanced metallurgy going on at Mount Milligan, copper gold system, as I understand it, kind of tricky metallurgy. So they were, really focused on that. But they were drilling off Berg at the same time. You weren't, as far as I understand, you weren't, following the mining sector in that time frame, but it was a bull market. It was a real big bull market in that 2008 to 10 phase. And so, this company would have been like, operating huge budgets and doing huge drill campaigns is kind of my memory of that. And so, yeah, they would have been generating a lot of core material and just kind of like, piggybacked on what they were doing with the Mount Milligan Met program to kind of do a standard porphyry copper flotation circuit program for Berg. But they're very different deposits, right? Like you're talking about Mount Milligan, at the risk of oversimplifying, is roughly like a 50-50 copper golds, and Berg is obviously very different. It's like copper, moly, silver. And so, yeah, like I think there was a handful of programs done. They were very focused on, okay, well, we got to produce a moly con, so let's first generate a huge volume of bulk concentrate so that we can do, a large volume of moly separation tests. And then they put together a pilot plant to do that. And the pilot plant didn't perform the way they wanted it to, which is, I mean, pilot plants are like, it's, when you're building a mill, like for operating purposes, you give yourself a bunch of time to commission it, to kind of get the kinks out so that it's like continuously operating in a well-behaved manner. The concept of a pilot plant is like, kind of turns that on its head. It's like, well, let's do something instead of batch scale, let's do it on a continuous basis, but we're limited in the volume of material we have here. So we're going to give ourselves like 2 days to stabilize it. And it just obviously doesn't work that well. It's like a pretty high risk endeavor. And so that's what happened. And so they had kind of subpar bulk con from the pilot plant that didn't really match any of the proper test work that they did on a batch basis. And then they tried to do a bunch of moly separation test work on that. And it was just kind of, it wasn't the right approach. So we have gone at it a bit differently here, which is like just batch everything, really, really, large number of tests, trying to like home in on the right reagent routine, the right kind approach to pH, the right approach to agitation, etc. And yeah, nothing particularly novel. It's all pretty basic off-the-shelf reagents. The grind size is nothing crazy. It's not like we're doing anything, there's no things like autoclaves or super fine regrinds or anything like that. It's all pretty vanilla type stuff, but it was just yeah, kind of more focused on, and a lot of mineralogy as well. So as we were going through the test work, you get a test that doesn't perform the way you want. Okay, send that sample in for mineralogy. Make sure that you understand if there's anything going on at the kind of like, mineral grain, mineral surface level that will theoretically predict why you're having that performance or not. So just better science. And yeah, so I think just through really diligent efforts there, taking our time, no rush, just kind of getting the right results at each juncture. Yeah, we got great results, and I think it's again, this is PFS level. Like there will be much more to do as you go to feasibility. You want to replicate this stuff. You want to better understand what the actual mill feed will look like as you approach feasibility mine planning. Like, what is the first year, the first 2 years of actual mill feed going to look like, and just do a bunch of test work on that stuff. So yeah, there's obviously more to do, but I think for pre-feasibility level knowledge, we're super happy with the program we did, as are the other professionals involved at Sanko and ALS and ARM for that matter. So
yeah. I can see that we've been at it for almost over an hour and a half, actually, at this point. And you told me you had a busy day ahead of you, and I've not been too respectful of your time here. But what's going on at Ootsa? And has your opinion on it kind of changed since the last time we spoke? In terms of what I'm really thinking about here is does it have to be in your portfolio? Is there some value to be realized? Because I don't think you're getting value for Berg in your share price now as is, let alone some of the other projects. So is there a different way to realize that value there?
Yeah, I mean the typical like corporate finance approach to like non-core assets, or can you make an argument that you're not getting value for something, and if so, is there sort of some corporate thing that you can do to monetize it or surface value? I think that that's always a question worth asking if they are non-synergistic assets. That doesn't apply here. So like if Ootsa was in a different country or whatever, sure, we'd have a proper think of that. I think here it's like, again, we consider ourselves to be in the business of defining and de-risking like a big copper development opportunity, a big copper development business opportunity, and we think the like counterparties there that will ultimately be partners in making that become a reality are the types of enterprises that value big land packages. They value big resource endowments above the level where you have like a defined project. So I guess the way I would kind of I'd categorize this, or the way I describe it, is like, a big mining company may look at the asset portfolio that SURG has and say, oh yeah, Berg is like a great anchor to this district. It's a big project. It screens well, like the economics are robust at a range of prices, and it's like, low risk. It's obviously got a ways ahead of it in terms of permitting and all that stuff, but it's from a like engineering execution perspective, like relatively low risk project, and demonstrates a 30-year plus mine life. And it's so that's like the anchor. And I think the types of mining companies that look at something like that, maybe they are not operating in BC today. This would in effect be like a new jurisdiction for them, either from the provincial perspective or even just like the local perspective. So to make a capital investment here, to actually operate there, requires developing a whole range of expertise and skills relating to that area. And so it's great to have an anchor project, but it's even better to see that, okay, if we succeed in this, we see that there's a pipeline, there's a pathway to having multiple growth opportunities here to expand our operating footprint or extend it in time. So it's not just Berg with a tiny little postage stamp around it. It's Berg in this broader land position, broader kind of operating platform where you could have, or footprint where you could have, Ootsa as a secondary project that comes online in parallel, or is at least something that says, okay, well, we're operating there for 30 years. We see enough mineral endowment there that either with Ootsa or further discoveries that are likely to be made, we could see this being like a 50-year district. Like that's kind of the really high level thinking that big copper mining companies often have about these things. Is they want to see an anchor beachhead, but they also want to see, okay, like if we're going to go through the effort of building something big, we want to see the potential to have expansions or just like optionality embedded in that. So for us, hiving off Ootsa to realize a little bit of value today, and by little bit I mean our market cap is small. It's not like we would, even if we monetize that for a significant percentage of our market cap, that the proceeds from that would not materially change the kind of picture of what we're trying to do. So it's a little like, penny wise, pound foolish, I think. Again, I think we're in the business of trying to like make this as attractive as possible to the enterprises in the world that put their shoulders and their balance sheets into building these sorts of copper businesses. And I think the key ingredients for that are obviously you got to have a good project. You got to have like a meaningful anchor flagship project. But I think maybe not sort of like the Family Feud thing, maybe not number 2 or 3 on the list, but certainly like 4, 5, and 6 would be big land package, pipeline of exploration opportunities, identified targets, big data collection that you've already done on that in the form of, geophysics and other things, and secondary projects, that kind of thing. So, and you see this with some other companies that are in the market that are doing really well. Like I think Marimaca has kind of that flavor to it as well. Core anchor project, but kind of like bigger thematic arm waving thing going on with some like really excellent exploration potential. And I think those are the ingredients that major mining companies care about. So for us to like attempt to monetize that would strategically not make a lot of sense for us. But beyond that, our view on it is very positive and favorable. Like I think the way I've summed it up in other conversations is, if we were to run the ruler over it on a standalone basis to kind of put forward a standalone PEA, I'm sure we could derive some good numbers there. There's actually a really good gold credit at Ootsa. So especially at $4,000 gold, like I'm sure we could come up with a mine plan there that is, much smaller tonnage. Like we could probably focus on like a 200 million ton mine plan at Ootsa with a dedicated, much smaller mill and branded as gold equivalent or something like that, and put forward something that's pretty interesting. I wouldn't even rule that out as a worthwhile idea that we might do in some value recognition campaign in the future. But from a purely kind of like practical perspective, then we would have a project that's kind of competing with Berg with respect to questions like power supply, questions like with regard to permitting and capital resources and First Nations type stuff. So like it's important to internally know like have views on value like that, and believe me, we do. But in terms of like raising a flag with the market on that kind of stuff, I can make statements like this and kind of leave the breadcrumbs for people to think about that and do some of their own work and think about whether there's good value there. But it's kind of a different kettle of fish to go out and put a flag down in the form of a study that says, hey, there's a development opportunity that looks like X, because at that point you then kind of step in you open a door where there's kind of follow through that's required or expected on that in the form of advancing it to the next stage. And I don't know if that makes the most sense for us right now. I wouldn't rule it out in the future, but I think having competing projects that are is something to be just kind of balanced carefully. And the last thing I'll say about it, I've been pretty transparent about this in the past. The special thing about Ootsa is that it sits 5 kilometers away from the only care and maintenance copper mine and mill in the province. The future of that is, not yet spelled out, or there's no guidance on that yet from its owner. I think that day will come at some point in the future. Their hands are full with Red Chris right now, which is approaching feasibility and is in the environmental assessment stage. That's a big project. Their hands are full with it. They can't really, I think that's the reason why they're not, why Huckleberry is not operating today. But the real simple story there is you've got a mine and mill that is, it's not done. There's definitely, there's ore, there's reserves in place there. There's value in place there that will be turned on again. And in the natural course of these things, mills like that will, especially when they're toward the end of their reserve life, they will start looking for, hey, what kind of satellite feed can we get to keep this thing humming, especially in a high metal price environment, so that we don't trigger a big closure obligation or closure liability. So to me, that's just a very logical business outcome. Can't really dictate the timeline on it, but it just feels like there's a sensible outcome there for that asset and infrastructure that's in place. And Ootsa is a very special situation kind of opportunity for that. So yeah, I mean, investors looking at Surge, like my refrain has been pretty consistent here. You can look at Berg, you can run the ruler over it on Berg and say, wow, this equity is pretty undervalued. And then kind of underneath that, you've got this second string project at Ootsa, which is like a big resource endowment. Again, look at just the gold, go to the technical report and look at, the grade tonnage chart, ramp the cutoff up really high, look at what the, higher cutoff portion of copper gold's resources would be. There's probably a pretty juicy, interesting project there. And it also sits right next to a mill that will one day be kind of wondering where the next 10 years of ore is going to come from. So huge amount of option value there that is just there for the taking with no, it's not really in our equity price today for sure.
And I'm sure you and I will be talking about in the future as some of these developments, and some of these assay results and whatnot start coming in. When do you think the next time is going to be that you and I should be sitting down for an update interview?
Yeah, I think certainly before the pre-feasibility study is released, I think once we get some additional data disclosure out around some of our data that says like, okay, all of the drill holes that have been drilled since the last resource have been released. So here's kind of a picture of how that data has changed. And I think if we ultimately render some decisions on the size of the project and kind of are in a position to give some guidance on that, beforehand in the form of a press release, I think that might make sense to give some added color on that as well. So I think there's probably enough kind of like fundamental stuff in the works to justify an interim update before the big one at the delivery of the PFS.
Yeah. I asked you this last time as well, so I'll ask it to you again. But what's been the biggest criticism you've received of Surge in the meantime, over the last 4 months?
Not a lot, Antonio, to be honest. So I hope this isn't an unsatisfactory answer, and I'm not blowing smoke, but I think I think what we're doing is pretty logical, and I think we're being pretty methodical about how we go about it. And I think we frankly get some good feedback and compliments on it. I think people recognize that, this would be a big project in Canada and in BC. So in the wrong market environment, it's, I think it would be hard to push on this, but it's not that. It's the right market environment for this, right? Like if you follow the political discourse in Canada, like this is a like smack in the middle of the bullseye critical minerals project that is relevant for what Canada is trying to do and what the province of BC is trying to do. And it has the right ingredients on the infrastructure and kind of like First Nations and community side of things as well. So, but it's I mean it's a big capital project. I deal with a lot. I talk to a lot of investors that I think are sometimes their questions relate to how to bridge that gap between you're a small company with a big project. How will you build this mine, and how does ARM fit into this, and what's the timeline? And so the truthful answers to those things are there's nothing wrong with those truthful answers. They're like the absolutely normal things that you deal with in mining, which is that junior mining companies are in many cases in the business of designing, de-risking projects, doing the hard work to actually create an investable construction decision ready opportunity. And once you get to that point, like lo and behold, there's actually a market that is willing to pay real value for that sort of thing. So I think we're in a emerging bull market in our sector right now, and so there's obviously a lot of investors who are maybe new to it that haven't lived through these cycles and haven't quite seen that soup to nuts type thing happen a bunch of times, and so they're looking at it more from like a self-contained small business mentality of like, okay, how will you raise all this money to build it yourself? And like, well, that is a possibility, but it's not the only possibility, and but we're obviously doing the right things in terms of talking to potential JV partners, potential offtake finance providers, potential project finance providers, in order to kind of put those pieces in the puzzle as we go down the road. But even that's not always necessary. It's like sometimes you have a project that you de-risk it enough, you put it on a plate enough that there's a market that emerges that can take it from there. So it's that, and then it's like I think a lot of the stuff around just BC, right? And that's again, it's an education type thing, right? Like I think there's a lot of projects in BC that have been around for a long time, and people have fatigue about it, and they don't always kind of understand what developments have happened under the hood, and how things are changing today versus 10 years ago. And I think on the it's a bit of a catch-all term, but on like the social license and permitting type square, again, I'll just emphasize it's complex in BC, but not in a necessarily bad way. Like I think there's a ton of opportunities for just like win-win-win type situations emerging, and the societal kind of attitude towards this is as good as it's ever been in BC. And I'm not the only one saying that. Like a lot of my peers, a lot of the just kind of market commentators that have a BC lens are in kind of furious agreement on that there's just a real positive attitude in the province right now to see mineral development advance.
Mm-hmm. What about, I asked you what the biggest criticism is you might have gotten over the SURG story. What's the biggest criticism you've got of me? What did you can't come here hoping to talk about that I've not brought up, or or something else among those lines?
Hard question to answer. I don't not in receipt of a lot of that sort of criticism, but no, I think we've covered a lot of waterfront here. What can I say? Like I think I think it's been a really interesting market environment in the last several months. Obviously, we've seen that borne out in the share price environment for a lot of these equities, the equity capital market environment. So we were early to that. We did a financing, as I said, in July, and I had a few folks saying, "Oh, you're lucky you got that deal off before the summer holidays," and then lo and behold, August was like, the one of the busiest Augusts probably ever for mining financings in the Canadian market. So very busy, like ECM time right now, and I'm hearing from lots of other corners of the market that like there's just a lot of demand for this stuff, which is maybe indicating like a inflection point in the market. Asset rotation out of non-mining equities, non-mining asset classes into our space. And so I mean, the seat I'm in is one of long-term thinking, and I'm not, to use my earlier metaphor of like lily pad hopping, I'm not able to engage in that type of stuff, and as a result, I kind of keep the posture that is not really geared towards that type of stuff. I'm trying to make like 10-year decisions, 10-year bets on things, and so that requires quite a lot of patience. And so everything that I'm seeing, everything that I'm saying is like literally been the same thing that I have been saying and seeing for 5 years. It just feels like it's starting to actually it's starting to become a little bit more recognized or something. Like I feel like I've been early to this particular thematic for a while, but what I've been saying for many years, instead of people disagreeing, there's kind of more agreement with it now. So I'm hopeful that I'm hopeful that we're entering a market environment that's like more constructive for these things, because it's been hard yards, and I think but I think like, just to kind of bring this back to maybe why some of your listeners listen to this stuff, like from an investment opportunity perspective, it's like, and this will be a repeat of what I said on our last conversation. Like I feel that at Surge, we have been adding value very consistently for 5 years, and the rewards for that in the form of like, equity market value have like really only just kind of peeked their head above the parapet. And so I think there's a long road of opportunity ahead of us. So I'm very excited. It's been a fun year in that regard. I think delivering a catalyst, like a pre-feasibility on a project that could, be in that snack bracket of like the largest copper development opportunity in Canada is a really great thing to be a part of. We've got a really good team around us. We're actually out hiring right now for kind of a VP environment role. So great to see the team growing. So yeah, I don't know. It just feels like stuff's firing on all cylinders, including the market conditions at the moment. And so that's the right kind of set of ingredients to just see stuff really start to happen. So I'm excited. It's a great opportunity to be sharing that with on platforms like this. So yeah.
Thank you so much for doing this. I really do appreciate you investing almost 2 hours again in me this time, and I'm looking forward to our next conversation.
Likewise. Thanks a lot.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Oh, so unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."